Well, John, again, good to see you. Sorry we're not in person, but certainly happy we're able to do our annual interview. Let's get right to it because we're already running short on what I know will be a great conversation in terms of our time here. Love to just start off, given where we are right now at this sort of unique moment in the economy, getting your sense for the economy. I mean, you have some visibility into Europe and Latin America, and obviously here in the U.S., you have some visibility to the consumer with the various businesses that you're invested in or on the board of, help run. So, what's your sense of things right now when it comes to the worldwide economy?
Well, I think that as a result of the pandemic, there was too much stimulus dumped into the financial markets around the world, principally in the West. And as a result, we're experiencing some inflation driven by demand exceeding supply, and that supply has been damaged by some supply chain issues, some of which still relate to the pandemic, some of it relates to some policy decisions on energy and the Ukrainian situation. So I would say the central banks are finally reacting to the inflationary pressures, raising discount rates, drying up some excess liquidity. And that's already starting to have a pretty good effect, I think, certainly in construction, housing, and the industries that support that are clearly showing a slowdown. It looks like perhaps labor inflation is going to be a little more persistent. Shortages of labor supply that seem to be not just in the U.S., but certainly in Europe as well, are kind of driving a little bit of excess pricing in the labor markets. And that's likely to be persistent in my mind. So we're likely to see, the surge of inflation slow down and plateau, but at a fairly high level.
Right.
Certainly higher than the central banks want.
Yeah. What is your sense of the consumer and how much demand destruction has taken place as a result of higher rates at this point? I ask that with keeping in mind Liberty Global, obviously, and its place in Europe and higher energy costs there, what you may be seeing on the ground in terms of people's willingness to pay for certain services.
So far, we haven't seen very much indication of consumers running out of debt capacity or liquidity, but I think it's right around the corner. If you look at credit card outstandings, if you look at delinquencies and mortgage, they're starting to build. So my guess is that there will be a little bit of a squeeze on consumer ability to purchase. Clearly, it's hit the housing market with these higher mortgage rates. And so my guess is that we're going to see a recession of some kind toward the end of this year into next year. I don't really think it'll be deep, in my own opinion, but it's likely to be very much correlated with what the Federal Reserve does and what the other banks do in response to the Federal Reserve actions.
Yeah. What about ad markets? I mean, typically it's one of the first areas that companies look to cut back on to some extent. What are your expectations for next year, given what you're seeing and given the fact that while you don't expect a deep recession, you do expect there to be something next year in the way of a recession?
Well, what I hear is that we're definitely going into a very slow, dramatically slower ad market as people are anticipating the future and starting to cut back on their ad budgets. So I do think we're going to see definitely, whether you call it a recession or a slowdown, there's definitely going to be a slowdown in the ad market. And across the board, really, that'll be everybody from the new streamers to the traditional linear stuff.
Yeah, well, you talk about the streamers, of course, many of which are adding ad-supported platforms if they haven't already. John, a key component of our conversations for many years now has been talking about the development of direct-to-consumer and the streaming business. But a lot has changed even over the last year. Certainly when one looks at that multiple that Netflix gets, a lot has changed. Not to mention a lot more questions about the ultimate profitability of the streaming business. And so I guess let's just start there. Has your view changed at all in terms of how profitable these businesses can be, given what seem to be continued high content costs and relatively continued high churn?
Well, you hit the two issues, which is it's a gold rush when it came to trying to buy enough content to get scale. Netflix clearly broke out into the lead big time and got scale, and everybody else who wants to play in that entertainment streaming space started to move in that direction. Some of them were handicapped by prior commitments on their content, but everybody started to move in that direction, and that created quite a demand for creative content, scripted content, and I think perhaps it was way overdone. That said, it'll sort itself out because sooner or later companies are going to want to be profitable, and at the moment they basically are not. I think Netflix's ability to foreclose any meaningful competition in that space is just unlikely. I think there's just too much content. The public has too broadly diversified tastes. So there will be multiple players in that space. It's going to be hard for them to achieve the level of profitability and consistent profitability that the dual stream of revenue of the traditional linear business had achieved, with margins and the programmers and the network owners getting into the 40–50% area. Going to be hard because of marketing and churn. So I think to be successful in streaming, you're going to have your own funnel. You're not going to be able to spend a fortune on advertising and promotion to gain customers, because the churn will kill you. So you've got to drive down churn, and the churn cost, I think, is going to be an important part of the equation. And, so if you have your own big funnel, if you're already present and can advertise or promote cheap, if you're already on platforms where it's a simple click to add something, I think that'll be an important ingredient in achieving profitability. But clearly there's going to have to be some consolidation. There's going to have to be some budgetary cutbacks on the level of spend by streamers, and it'll sort itself out. No question, right. The public enjoys television this way. The real question is, from the investor point of view, can it be done and supplied in a sustainable, profitable, and low volatility way, or are people basically going to click on and click off, and you can't afford the lifetime of a subscriber, may be pretty short, and the investment in getting that customer may not be amortizable.
Yeah, well, I mean, John, this can't go on forever, as you say. I mean, Discovery's losing money on direct-to-consumer. My parent company, Comcast, is losing money on Peacock. It doesn't even have anywhere near the scale of a Discovery Plus or HBO Max. Disney is saying they'll be profitable in direct-to-consumer by fiscal year 24, but there are plenty of people who are not sure about that. And on from there. I mean, this period of rationalization that you're talking about, are we in it now? A year from now, are you and I going to be having a very different conversation?
Well, I think everybody I know is taking a hard look at their content budgets going forward and trying to be more targeted in terms of what audience they're after, not try and have everything for everybody, perhaps. So you might see some specialization that leads to profitability earlier for segments. for subsets. I'm a believer in an a la carte menu for the consumer, but I think if you're going to keep churn down, you have to bundle. It would appear that Disney's approach is to bundle internally. In other words, have 3 or 4 services streaming that you can combine and try and satisfy a broader household, but all internally. There may be opportunities for streamers to bundle with other streamers, not co-own, and there
Really?
may be, yes.
Really?
And then there may.
I mean, how does that work, John? Bundling, I just wonder, the level of cooperation needed to bundle independent streamers, not within the one company, as you point out with Disney. That level of cooperation, do you really think you could ever see that? Because would each of them have to moderate their content spend, or would reduce churn?
Well,
I just wonder how that would work in your mind.
Well, think of it this way. I think Discovery's target audience and HBO Max's target audience are completely different. So one could contemplate the combination or the bundling of those 2 services at some kind of a consumer discount as something that would stabilize churn. If they had been independent companies, they might have ended up doing that kind of a thing. It's been discussed, David, amongst various players. What do I have to add to my stream in order to stabilize it, to make it more difficult for a consumer to decide to disconnect after they've seen a hot show? It's I think, going to evolve. People will figure it out. It may take bundling with something, frankly, other than entertainment programming. Maybe
Right.
Sports, stronger bundle, or maybe even connectivity services will turn out to be a stronger bundle.
Right. Although, all right, let me just get this straight. A bundle of things that include sports and maybe news and are ad supported. It's reminding me of something. It reminds me of the old cable business. I just wonder, do we end up recreating what we all had?
Yeah, you can ask yourself a very simple question, which is, why did TV everywhere not work? Why was it not possible that essentially all of the channels that people were used to watching would evolve to be random access, right? So you can watch them curated and linear, or you can watch them random access. They could all have advertising or not. Kind of, why didn't it evolve that way? And I always ask that question about why didn't that work? Why weren't people happy with random access to their linear stuff? And the answer really turned out to be, I think, that the big bundle was too expensive because it contained way too much sports cost. And it was not possible for distributors to unbundle because of contractual obligations. I can go back to, when I was chairman of DirecTV. We had a linear video-only product, and our ARPU was like $122 a month. That's a lot of money if what you want to see is something that you can buy from Netflix for $8. So I think what happened was, for many consumers, the big bundle became too expensive. And the evolution of the big bundle into random access to a la carte channels didn't happen for contractual reasons.
Mm-hmm. Mm-hmm. But John, so, let's talk a bit about the presence of sports and potentially news in the streaming world and how you see it evolving. You mentioned, of course, sports brought up the cost overall of the linear bundle and may have been one of the key reasons why people disconnected and continue to. But how do you see sports playing a role in this evolving world we're talking about, and/or news, both of which are also the glue, as you've talked about many times, that keeps people in the old bundle right now?
Well, first of all, those are really the only 2 live services left on television, right? To speak of. And, news and sports, including your channel. So nothing's more topical than how the stock market's doing today. That that sort of defines the core service. The same thing with sports. It's not very interesting when it's time delay. So those are important services. Now, news in particular, the linear audience for news seems to be declining. It's not that huge, but the amount of internet news that from the same editorial source seems to be growing very, very substantial. So even the social networks, most of their news is essentially editorial coming off of people who used to be regarded as linear. So we're seeing an evolution of news content. When it comes to sports, one still sees enormous market power in sports as long as there's competition amongst distributors. So that if a distributor feels like he has to have it or he's going to lose a meaningful number of his customers to somebody else, to a competitor, he'll pay the price and hope that everybody pays the same price so that there's no competitive disadvantage. The problem with that is you end up with a total bundle cost that just starts to drive people away from the bundle in total. Now, in Europe, we've had some experience where sports is almost all a la carte, professional sports. And so the video bundle in Europe is holding together much better, with broadcast still being an important component than it is over here. And I think the principal reason is the different trajectory that sports has taken in Europe versus over here.
Yeah. How do you see those streaming and sports evolving? Obviously, Amazon, NFL Thursday, some baseball as well. We haven't even really talked. Amazon and Apple are sort of their own little universe because they can spend whatever they want. But, you know, is it going to be bifurcated in terms of rights? Are the leagues going to be happy if they have some that are direct to consumer on a big streaming service and some that stay with the linear cable world? Or is it going to completely change?
Well, as you know, I mean, for instance, Formula One is a sport that I'm fairly familiar with. And the strategy of, do you move Formula One over to streaming and get paid a lot of money by a streamer, or do you continue to bifurcate it, have a lot of it on broadcast television or free to air, let's call it? How do you want, and as you're trying to build up scale and support for a sport, reach is very important. You want the broadest possible exposure of your sport, and you want to be able to promote it on the broadest possible platform. On the other hand, people who are looking to share shift might be willing to pay you a lot of money for a year or two of sports rights. That's really, if you go back in history, Sunday Night Football was really created by the industry, by the cable industry, really to bail Ted Turner out of his overpayment for MGM. We had to create a revenue stream, and so we got Sunday Night Football games on a new channel called TNT, launched it. The industry pretty much had to carry it, and that was a cash flow stream that was sufficient to recapitalize Mr. Turner. So the history of using sports as a locomotive or as a marketing tool, you know, has a long history in our business. And I suspect that it'll be experimented with by the Apples and the Amazons to see how sticky it is, you know, how sustainable it is. The leagues are going to have to be careful. They don't want to end up with a very high-priced premium service with no reach, because then the kids will stop watching the sport, right? So it's and the guys who run these leagues are very smart guys, and they've got this pretty well figured out, how to balance reach, promotion, with their short-term economics.
Yeah. Well, how do you view, I mean, you mentioned Amazon and Apple, you know, both specific to their willingness to potentially spend on sports rights and then just on content. They have limitless amounts of money. Amazon's under a little bit of pressure lately on cost, but compared to the other companies that are judged literally on their ability to garner subscribers and or not lose money, it's a very different equation. So how do you see them playing here? Do you think they're going to be aggressive when it comes to not just content and continue to build out their streaming services, but sports rights?
Well, I differentiate them quite a bit. I would say Apple, from my discussions with executives at Apple is very intent on making sure that they keep their quality level extremely high. They're willing to add video content to their offerings, but they want to make sure it doesn't damage their extremely high quality brand. And so they'll continue to expand and invest, in my opinion, if they think it's enhancing the quality image that they try to purvey. The Amazon guys, I think, are more commercial. I think that they're still experimenting. They're trying sports. They're trying content. They're trying ad-supported content. They've gone with Freeview to see how many slices they can make in the bologna. You know, I mean, yeah. They're still, I think, trying to figure out the optimum role that they can play as a bundler, as a promoter. You know, it remains to be seen where they take it. My guess is that Netflix and Disney are responding to the slowdown of their unit growth and are now trying to have a lower priced product with advertising where they can supplement their revenue with advanced advertising and get their product ARPU down to where they have a more affordable or broader affordability. And they're both going to be experimenting with that. And I'm very curious to see how that evolves.
Yeah, what are your expectations when it comes to ad-supported? As you say, we're seeing Disney and Netflix just rolling it out now. You think it's going to be a success?
Well, here's the dilemma that I see. If it's free and ad-supported, I think people will watch it and they'll tolerate the ads in entertainment programming, in movies and series. If it's premium, you know, they're used to premium not having ads. I mean, they've been trained that way. I'm a little skeptical as how many people, to save a few bucks, are going to be willing to tolerate ads in what I would call long-form entertainment programming. I mean, at the beginning, at the end, maybe. I don't know. If you start pushing a heavy ad load, you know, I'm not sure people will find it as interesting. I know in our household, my wife would not. Okay. She'll tolerate Freeview if it's got something on there that's the only place she can see it. And she'll watch the ads, but she knows it's free. So she's not angry at the service provider. So it'll be very interesting to see. This is very much about human behavior, I guess. How much is a couple to you? And will you get churned down? Will people churn down? And will this be at a lower price point? Does this make it more stable, less churn? I don't know. There's a lot of experimentation. This is operations research 101.
No, it is. I know. I mean, in your household, the concern may not be as much about what you're spending a month, but there are plenty of other households where it will really make a difference, potentially.
Yeah, and it's even a psychological thing. We have no problem watching ads on HGTV, for instance, that are related to the subject matter of the show, right? If Home Depot runs an ad on a house and garden, you know, home redo thing, it just sort of fits. If it's a high critical moment in some drama, and all of a sudden you're going to watch 2.5 minutes of ads. I'm not sure that goes down as well, but I think we'll learn. I think this will be a learning experience. The big concern, of course, is the profitability, the ability to generate the cash to pay for all this content was pretty well established in the old linear model. It's not entirely clear, how big the pot of gold is going to be if we get a full transition to random access.
Right, which, of course, we'll continue to talk about. John, let's talk a bit more specifically about discovery, something we have discussed a year ago, and then we did a subsequent interview as well when the deal closed. It hasn't been good in any way from a stock market perspective. The stock was as high as 36. It's 11 or below.
Yep.
What's wrong with Discovery? Why, at least at this point, has the market not been happy with what was planned to be obviously something that created a lot of value?
Well, I wouldn't give up on it. I think the basic logic of being able to take the enormous collection of intellectual property that Time Warner CNN represented and exploit it in a more profitable way, I think that promise is still there. No question that the timing was terrible because streaming was the end all for AT&T a year ago or 2 years ago. And they really threw the kitchen sink at their efforts to get scale in streaming with HBO Max. It did not prove to be very rewarding. And so when the deal finally closed, Discovery found themselves with a streaming business that still had promise, but had not achieved the kind of growth that had been anticipated. And on the other hand, David, Time Warner and Discovery are companies that touch the food chain of entertainment in a ton of places. So in other words, it's a collection of a lot of different businesses. Most of those businesses are quite profitable and quite viable. Some of them are even growing. But the concentration on streaming, the bet the farm on streaming, did effectively put Time Warner between a rock and a hard place in the short run. And I think it was the motivation, frankly, for why the transaction was even contemplated by AT&T. And Discovery found themselves post-close with a more difficult situation than they had anticipated. Right. So all true. Now, I never thought that the stock of the combined company was going to be a great performer. There was an enormous redistribution overhang because you stop and think that 71%, I think, of the stock that was issued was going to shareholders of AT&T who were in AT&T primarily for dividend yield. And so giving them a piece of paper that did not have a dividend was sure to cause a lot of redistribution of those holdings and put downward pressure on the stock. So you combine all of those things, a disappointment in the success of the scale of the streaming business, and that redistribution overhang. I think that to some degree is responsible for the depressed stock price. Now, it is still a company, by the way, that is generating free cash flow, unlike some of the other streams. And in fact, I think what you'll find is when the synergies have fully kicked in, it will actually be generating a lot of free cash flow. And so the current appearance of pretty high leverage, I think, will start to dissipate over the next couple of years. This has always been a long-term game, this merger.
Right.
And I still think it a lot of favorable prospects. Keep in mind, Discovery's appeal from the other side was Discovery is probably the most broadly distributed content brand presence in households on a worldwide basis. You know, billions of households watch Discovery channels. The ability to promote a new product or service or piece of content to launch on a global scale is still there. And I think that will prove to be very powerful. But it's all a learning curve. I mean, we still have a very large linear business. We still have a large produce television for other distributors business. We have a theatrical business.
I know you've got them all. But John, I mean, David Zaslav, that learning curve that you mentioned, you know, as a board member of this company, and obviously as somebody who knows Zaslav very well and has been a mentor to him for many years, do you see him making the adjustments he needs to in terms of adapting towards profitability for a business that was all about just getting scale and perhaps scale at a price that wasn't worth paying?
Well, whenever I talk to David, the first word out of my mouth is manage your cash. This is going to be a business that one should keep a very clear vision on cash generation. That will ultimately be the metric that David's success or failure will be judged on. Keep in mind that the good news is, yes, it's got leverage, but its leverage is very long-term and relatively cheap in this environment. I believe their average debt cost is 4%. Their average maturity is 17 years. So when we went into this, the board knew that this wasn't a short-term game. And we made sure that our financing would give David the time to shrink the leverage over time with the free cash flow that the historic businesses are capable of generating, and build something that the market really wants long-term, a collection of assets perhaps that the market wants when this whole situation stabilizes. So, you know, I'm pretty comfortable that if you're patient, now this is going to be a patient thing. It isn't going to be overnight, and there's going to be a lot of grumbling because you don't generate $3.5 billion of operating synergies without, you know, breaking a few eggs.
No,
it just
understood.
has to be.
But John, the linear cable business is also kind of dissolving in front of our eyes as well. And that's the generator of most of the free cash flow here. I mean, it's not like you got forever. You got to figure this out.
No, that's exactly right. There is time. I wouldn't say dissolving. I would say transforming. You know, some of it is shrinking for sure, but some of it is actually transforming the nature of the consumption of the television. And as I said before, I'm still a believer that the people who spent all this time watching channels like the Food Network and HGTV want to continue to watch it. The problem is if they've disconnected from an $80 cable package with a lot of sports in it, right at the moment, they don't have an easy way or have not had an easy way to continue to watch that kind of content. And that's the cord cutters, let's call them. So we have to make sure we give them an easy, convenient way to watch the content that they have historically loved to watch. And that will then bring and keep the advertising revenues of the advertisers who find those particular types of services attractive to advertise on. So to me, it's a transformational thing, David. I thought you were going to ask me a little bit about the cable business, you know, the traditional business.
We'll get to that. We'll get to that. We still got some time. You know, you mentioned the capital structure, though, of Warner Brothers Discovery. Would you want them to buy back some of these, even intermediate-term bonds, not the long-term ones, but the intermediate ones that are trading at significant discounts to face value? Is that an opportunity for Zaslav and company there to buy some of that debt back?
Absolutely, it's an opportunity. We clearly we announced, I think when we announced the original deal, that the goal here was to take the leverage down over the first 3 years to something in the neighborhood of 3 times, right? Well, nothing helps you better doing that than being able to take debt out at a meaningful discount to its trading price. So very clearly, that's an opportunity. Nature does tend to help you heal.
And you recently, I think you sold some puts, right? In other words, you took a more bullish position on the stock as well. You didn't buy it outright, though, but you did do a transaction. Am I correct?
Yeah, first of all, I own a lot already. Second of all, selling a put, I had to sell puts at least of a duration so that I'm not a short swing player, right? And that was, to me, the simplest way for me to play. I have a Hart-Scott-Rodino filing issue, and I take, or believe it or not, even though I don't have the kind of high voting interest that I used to have, I still have a Hart-Scott-Rodino issue. So selling puts was a way for me to defer having to file Hart-Scott-Rodino for 6 months. I'll have to file it before I take possession of more shares. And I don't know how hard the government's going to give me a hard. They usually give me a hard time, David, in all honesty. So, if I can avoid filing, try and avoid it where I can. So this was sort of a way I could signal my support of the company and David, and do it and still be compliant with government regulation.
Got it. Got it. John, it was a surprise to me that our interview last year, the biggest takeaway was your comments about CNN, in which you said to me at the time when we were talking about different assets at Discovery, you hope it evolves back to the journalism it started with. So here we are a year later. What are your thoughts about CNN and some of the changes you've seen there, and whether, in fact, those sentiments that you expressed perhaps have led to some of those changes?
Well, I've met Kris, the new head of CNN, once. I was quite impressed that he saw it, this sort of the way the board saw it, that being in the global news business, you needed to make sure that the news portion of your programming, if you're going to have a linear channel, David, in news, it's got to be entertaining, right? Well, you can't do hard news entertaining continuously 24/7. So your hard news portion should be extremely trustworthy, solid, not spun, not manipulated in any way. I think it's fine to, in my opinion, it's fine to then have a view from the left, a view from the right, a view from the Looney Tunes, whatever kind of view you want, that's defined as that. And the company can even have an editorial policy if they want, which is clearly defined to be an editorial policy. They need to separate it from the hard journalism. And I would love to see, the core of CNN be hard journalism. I think CNN has some great journalists. So none of this was ever an attack on, the vast majority of the journalists that work at CNN. It's more the selection of content, what you're going to focus on, what kind of documentaries should you be doing. I would just love, I'm first and foremost, despite my Irish heritage, I'm an American. I want to see this country succeed. We are so divided as a country. I would love to see our media establishment pay a little more attention to the things we can agree on. Support politicians who are willing to compromise with the other side and make good things happen. Otherwise we'll never solve the big strategic issues that face the country. Our Congress is completely dysfunctional. And that's really where, under our Constitution, good stuff is supposed to be decided. Strategies and how you fund them are supposed to be focused on and decided. And I would just love to see, the entire journalistic community put a little more emphasis on things we can agree on and defending people who are willing to compromise, as opposed to maximizing ratings by going off on a tear. You know, that's just my personal view. Now, I do think news will to be much more random access. News is going to turn out to be much more curated. I believe you're going to be able to sign up for the things you're interested in, and you'll have a customized collection of stories and articles that you can just tap into whenever you choose to.
Yeah, but John, that world you're describing is one of the is a siloed world. It's one where your own opinion just gets spit back at you time and again. It's not what you seem to be hoping for in terms of at least what you're looking for from CNN to sort of broadly inform and try to bring people together in some way.
Well, there's a bigger world out there than just U.S. politics, okay? And if it was me, I would start by trying to inform and entertain people on the subjects of interest beyond the purely domestic politics. I think it's gotten way too narrow in that regard. And there's no reason why you can't have an informative congressional hearing or an informative interview with participants on both sides, the goal of which is to actually inform the public in depth of the considerations that go into various policies and strategies, whether it's a long-term energy strategy, whether it's long-term, what do we do about healthcare long-term with this aging demographic that we have? I mean, there are a lot of these things that really Congress is where this is supposed to happen in our society. And I think media could play a role in forcing Congress to actually do their job.
It would be nice were that the case. Well, on CNN, let me just end with this. Do you still see it as an important component of this overall company? You know, when I'd asked you about it last year with the intent being, could you ever imagine it being sold? I think your answer would be a way of chickening out. How do you see it fitting right now?
Well, one of the reasons why I didn't think CNN Plus could possibly survive is it didn't include CNN. So why didn't it include CNN? Ask yourself that question, David. Because of the contractual relationships that the company has with distributors. It couldn't include CNN. So you're going to have a CNN Plus, but it's not going to include access to CNN, which would seem to me to be the issue. I mean, if you have, 45% of U.S. households are not buying the cable satellite bundle now, how are they going to see CNN as a linear service? Well, you got to offer it to them as a linear service somehow. You got to get it out there in front of them. And whether you redefine it, whether you make it a premium system, I mean, I don't know how you get around the contractual limitations, but the goal should be to get it in front of 100% of potential viewers and not settle for a shrinking subset. I mean, to me, that's the number one goal. And whether that has to be a streamed internet service, whether it's people come to your website to see individual stories. What I know is the news services that I sign up for, a lot of the content is CNN editorial. Yeah. And I know there's something over 100 million people a month visit CNN to pursue the stories that are there. So once again, it's a question of how do you get people in the habit of going there, or how do you make it easy for them to see it? I mean, how do you eliminate the barriers right now to them benefit from the editorial efforts you're putting in?
John, I only got, unfortunately, about 10 minutes left with you, and you did mention the cable business. Your old love. So let's get to it as quickly as we can. Starting with broadband growth, which seems to be slowing. Competition from fixed wireless, competition from the overbuilders. Obviously, my parent company is Comcast. You still own a significant stake in Charter through Liberty. What are your views there in terms of whether good old-fashioned cable is going to be able to succeed in growing broadband subs and or maybe compete in wireless as it is already in a more significant way?
Well, the first bitch that I would have is that network neutrality was foisted on us by big tech and regulatory pressures, and created a superhighway that we all invest in and provide the facility for big tech to use with zero correlation to the capital capacity pressures that big tech puts on that distribution platform. So if you say fundamentally what's wrong here, to me, the number one thing that's wrong from 100,000 feet up is that people can, that edge suppliers, let's call them, can put stuff on that loads the system up and have no responsibility, no cost related to the pressure that they put on the network. So there's a disconnect there, and that's, to me, it's unfortunate. When Zuckerberg wants to put Meta on, and it requires very low latency and potentially huge traffic to a limited number of customers, are all customers supposed to underwrite the few customers that want to try that by requiring the distributor to make the capital investments necessary to support that? So that's bitch number one, but I'll set that aside for the moment. I think European central governments are starting to understand that and may attempt to have some role, some regulatory role in that I would call it inappropriate structure. One of the interesting things, David, for me, my good friend Mike Freeze, we were on a board update the other day, and he pointed out that in his European markets, convergence of wired and wireless has gotten to the point where the video business is a relatively tiny portion of their revenue stream. And it's an even smaller percentage of their cash generation because the margins are somewhat squeezed. So I would say Tom Rutledge would tell you the same thing at Charter, except they're earlier in the process of becoming a connectivity company with roughly equal wired and wireless components. But yes, the industry is going that way. It's really becoming much more a connectivity business and much less a video transport business, because increasingly they're transporting video, but passively, not actively.
Right.
If you get what I'm saying. And that largely is, that's largely the result of network neutrality. So, yeah. So I make my circular argument there. With respect to the growth of broadband, I think that there's been a lot of too much cheap money floating around, which has led to speculation, in some cases actual investment in overbuilding, which frankly is not going to have good economic returns, especially in an environment of higher interest rates and harder to get money. So I do think some of the pressure on the incumbent distributors from, speculative competition will soften here. It's just not likely that an infrastructure fund that's promising 5% long-term returns is going to get a lot of equity if they have to pay 6 or 7% for their money. Okay, it just don't equate. So I think you're going to see some change in the dynamics of the business. The other thing that's happening is some of the competition that the existing broadband guys have is coming from people who are using excess capacity from their 5G systems.
Right, you're talking about T-Mobile's fixed wireless product right now. Yeah.
A lot of that opportunistic excess capacity will dry up. I think you also know that even Elon Musk's satellite system is going to have to start having much higher prices for heavy users because they don't have enough capacity. The terrestrial broadband business is the only asset that has, almost infinitely expandable capacity. And even your company is probably, I don't know what Brian is telling the street yet, but I think the U.S. domestic broadband guys are heading toward 10 gigabit bidirectional networks. It'll take them a couple of years to finally get there. There's just no way that a spectrum-based alternative is going to be able to provide the kind of capacity that kind of a broadband network will provide. So yes, around the edges, you're going to see some competition. The other thing I would say is the pandemic brought forward, I think, a surge of broadband connections that probably borrowed from the future a little bit.
Yeah.
So my guess is, I think you'll see a return to low single digit unit growth in broadband. What you will see in the traditional carriers is a surge of wireless customers and revenue. So the growth will
come from there, John. Unfortunately, I got only a couple of minutes. But on that note, I mean, you and I once talked about Charter and Verizon. It was something. It didn't happen, but it was certainly entertained. I mean, is that something you could imagine in future consolidation where we once again reconsider connectivity, broadly speaking, with one of these big wireless players? Or do Comcast and Charter create their own?
Well, if you look at what we did in Europe, we basically in Europe have combined with the major wireless carriers on a country by country basis, whether it's UK or Holland, or Switzerland, or Belgium. In each case, we merged with or acquired a wireless company and joined it with the broadband company. So we've already done that in Latin America. We've already, for instance, in Chile, we just did it with the number 2 wireless company. We just merged with Carlos's cellular company in Chile. So that's happening around the world because this connectivity works better if it's across wired and wireless platforms. In the U.S., I think it would be more an antitrust question.
Yeah.
Think of the synergies if we could put Charter together with Comcast. And on the question,
that'll never happen. You know that. But could that ever happen?
The question, well, never say never. But in the short run, the opportunity for Comcast and Charter to roll out initially using Verizon's network, rolling out a very competitive wireless bundle, I think is showing good results. I know Charter, I think, announced around 400,000 net gain this quarter, of wireless customers. And the nice thing about it is that bundle is very sticky. You get much less churn, with that combination. There is spectrum, by the way, that Charter and Comcast own together, that they can build out their own radios where it's economical for them to do so. So as they build scale and volume, they can selectively build components of their own network and supplement the Verizon network as it seems cost effective to do so. So the answer is, sure, why not? I mean, I was a big proponent of Charter buying T-Mobile back a couple of years ago. When I first got involved with Charter, I was pushing it. I even talked to the FCC chairman at the time to see what he thought about it. And I thought it was quite doable. And as you know, Massa tried very hard to get involved with Charter when he controlled Sprint.
Yes.
So like these things haven't been talked about and even analyzed on paper.
No.
So I never.
Yeah, you never say never. Maybe we'll come back to them. All right, finally, John, just in terms of consolidation, because I always like to talk deals with you. We always have fun, at least with it. Back to streaming, back to the rationalization there. I mean, do you think, you talk about the need for scale. Do you think 2023 will be the year that we see Comcast make a decision to do something, or Shari make a decision that it's time to do something, maybe sell, or on and on from there? I don't know, or Warner Brothers Discovery even.
Yeah, who's under pressure to do something? Well, I think just looking at cash flows and flexibility, probably the one that'd be under the most pressure to do something would be Shari. Simply, she's to get scale. She doesn't have the balance sheet to get scale, and she's running at pretty high leverage right now. And I think the dividend needs are still pretty strong. So maybe at some point here, Shari wants to do something with somebody else. You mentioned the big guys. The big guys, could buy any of these companies and hardly blink. Brian does not need money. He's got plenty of cash flow coming out of his distribution businesses. But I think, his tolerance for funding a deep bleed, he's going to want to see some strategy that gets him out of a streaming bleed, I think. I'd have to guess. And that might be a synergistic combination with somebody else to get scale, or he may just exit, take his Hulu money and build another theme park, which he's done extremely well with. So, I don't know. It's hard to predict what the Amazons of the world might decide they want to do. They might want to own something rather than rent it. I think an interesting one would be ITV in the UK. It's probably the second biggest studio. It's probably the biggest studio outside of the US in terms of content that it produces and quality content. And its stock has been pretty beat up. So there may be something happen internationally that's hard to predict. The big telcos are grinding along. I still think there's, they just got rid of the fourth player by combining Sprint and T-Mobile, but now the cable guys are emerging as a reseller of Verizon as the fourth player. And cellular business ain't great if there's four aggressive players. So maybe there's got to be some further consolidation in the cellular world.
Interesting.
You mentioned.
Right.
There would always be synergies in going from 4 to 3. Look at the discount airline industry if you want to pay attention.
Yeah. Well, John, it wouldn't be sorry. Finish your thought.
No. Go ahead.
Well, it wouldn't be a John Malone interview if you and I didn't at least go through some possibilities of consolidation, which is always fun. And always great to obviously get your thoughts in general. John, thanks for spending the time. Appreciate it.
You betcha. Take care, David. Thank you.
You too. You're welcome. Thank you.